Around here, we say that retirement isn't the finish line, it's the starting line. And that's because as you're cruising through retirement, that could be 30 plus years, you might get smacked with some surprisingly large tax bills down the road because of required minimum distributions, or RMDs. RMDs are the distributions that the IRS forces you to take out of your IRAs, 401ks, pre-tax investments. What we like to do is show the people how to lower those RMDs and ultimately lower your lifetime tax bill. Today's show, we're going to give you 3 smart strategies that you can use to lower the RMDs and lower that lifetime tax bill. Because why overpay in taxes to the IRS if you don't have to? I'm Brad Lineberger, Certified Financial Planner.
And I'm Matt Callahan, Certified Financial Planner, and this is Navigating Retirement. Let's jump in.
Matt, let's first talk about what are RMDs, how do they work, and kind of what's the structure of them?
Yeah, so it's a required minimum distribution. And before we go in, it's the minimum, right? So you can always take out more if that's what you want to do. But what it is that it's at age 73, the IRS makes you take a certain amount of dollars out of your qualified accounts. So 401ks, IRAs. Roth IRAs do not have required minimum distributions.
Right.
If you were born 1960 or later, your RMDs are now 75.
75.
So
right.
pros and cons here. We're running into a lot of things we'll probably dive in later, but some people don't need their required distributions. So they're saying, this is a good thing. I don't have to take them for a couple more years. But over those next couple of years, maybe your account's growing bigger. And so this is where a potential landmine pops up, is that the RMDs the amount is determined about the account value. So
Right.
if the account value gets bigger, you're going to have to take out more.
And so what I'm seeing consistently across the board for almost everybody I work with, the required minimum distributions that they're being forced to take out are more than they actually need to live on. Mm-hmm. And so what's happening is they're having these large tax bills, and it's through no fault of their own. The IRS is making them take it out because the IRS wants their tax dollars.
So it's weird. It's a phenomenon to think about, because all these people contributed to these accounts because that's what the IRS was saying. Hey, save. This is the right thing to do. And now they're penalizing you on the other side and saying, hey, pull these dollars out. We want our tax dollars.
Well, what I think is funny is that before the age of 59 and a half, while you're working, if you take money out of your 401k or IRA, you get penalized, 10% penalty. Then the IRS disappears for 13 and a half years, and then they show back up to the party, and now they penalize you if you don't take money out of here. And it's steep too, 25%.
Right, and that's a high number, 25%, but this was actually lowered from 50%,
Yeah.
so it's a steal at 25%.
Yeah.
So just be careful, like that 25% penalty is if you don't take the appropriate amount out for your required distribution. And so it's 25% of what was supposed to come out, and that's in addition on top of your federal taxes.
Right. So if you inherit any IRAs, you need to be taking RMDs. You've got 10 years now for any inherited IRA to deplete it. So.
Well, yeah, let's unpack that a little bit. So a couple of rules here. Anyone that inherits an IRA now after 2020 has 10 years to do it. If you are a non-spouse beneficiary, that means if the person you inherited the account from was already taking required distributions, you do still have a distribution each year for those 10 years, and then it has to be fully depleted after or on the 10th year. If they weren't taking RMDs, then you have the flexibility to maybe delay taking distributions all through those 10 years. It still has to be fully depleted. But for example, let's say you inherited an account from a non-spouse and you were in your last year working and it was a high income earning year. Maybe you don't want to take an RMD that year to delay it till the next year to keep taxes a little lower.
Before we continue, if you'd like help with your retirement planning, visit us at seasidewealth.com and book an introductory call. Now back to the show. And the way that the RMD actually works is you look at the account balance on the last trading day of the year. So late December, last trading day of the year, you get that balance. Then you go to the IRS Uniform Lifetime Table, and there's a factor in there. And you basically divide the account balance by the factor, and that tells you how much you got to take out. And when you're first doing it, it's around 4%, but that percentage continues to increase. And that's where those problems come in, is as you age, you're being forced to take out these really large amounts. Mm-hmm. All right. So we're going to talk about 3 strategies or 3 things people can do to make lemonade out of lemons, as we like to say around here. Let's talk about, for the person that still has time, the person who's not yet RMD age, 73 or 75, there's something that person can be doing strategically, which is Roth conversions. And the Roth conversions, that's the process of taking money out of your IRA and converting it to a Roth IRA. You pay taxes in the year that you do the conversion, but as you said earlier, Matt, Roth conversions don't have RMDs. So you essentially eliminate the RMD in that future large tax bill that's coming.
Yeah, and I mean, another tax strategy here is the Tax Cuts and Jobs Act did not sunset. So we've got these lower tax brackets, in my opinion, of 10, 12, 22, 24. I mean, 12 was supposed to go to 15, 22 was going to 25, 24 was going to 28.
Right.
And I mean, in my eyes, I've switched my planning, because 24, I used to say that was kind of a gray area, maybe even leaning towards no on Roth conversions up that high. But now, if you look at it with the turning lemonade or lemons into lemonade, we're saving 4% on taxes if we do that today, assuming that's where taxes were supposed to go to.
So the way I like to think about it is we call it the gap years, and it's the years between when you retire and when RMDs start. When you find yourself in the gap years, definitely do Roth conversions, I guess, depending on, but if you're in the 10 or the 12% bracket, it's a no-brainer. You absolutely should. And I agree with you, Matt. 22 and 24% bracket these days is now, I lean towards probably yes. But that's where good planning comes in. I mean, you need to be doing these projections, not just next year, but 10 years out, 20 and 30 years out. It's easy to do. Talk to your financial advisor. If you don't have one, come talk to us. But we'll do a multi-decade projection, and then we'll be looking at how much money can Roth conversions save you in your lifetime tax bill. And in order to do this, the other key the nugget that you got to take away, you need to have some money built up somewhere to live on the first few years of those gap years, cash or a taxable investment account, because that's what you're going to be drawing down while you do the conversion.
Yeah, you also need to be aware of some of the other ripple effects of the taxes. So we said 22, 24% is great for Roth conversions now, but if you go too high on there, then you could be introducing IRMA penalties. So additional premiums on your Medicare if you're 65 or older, or I should say, starting at 63, you need to be hyper aware of how big your conversions are, because it could introduce things like net investment income tax, which is 3.8% on your capital gains rates. Could increase your Medicare premiums on Part B and Part D. More of your Social Security could be taxed at that point. Right now, we've got the enhanced senior deduction, which has a phase out. So if you do too big, you could be reducing that. So all of these are fine. I'm not saying don't do conversions, because you could be causing other things. But if we're aware and understand what's happening, that's what you need to do. And so I like what you said, is having that Roth conversion strategy built out. But I wouldn't say that's your strategy. I would say that's the concept of what you're trying to accomplish. It's really every year you need to be looking at, how did the year end up? Or like maybe October, end of the year kind of thing. How did the year end up? Were there any capital gain distributions you were not aware of or that came out? Do you want to do a Roth conversion? Do you have the extra dollars, like you said, for Roth conversions?
Right.
And then do you want to pay that extra money? I mean, it sounds great when you see these strategies like, oh, I can save millions of dollars, but do you really want to write a $22,000 check today to the IRS? That's a hard pill to swallow, right? But that's the conversation. Okay, oh, guys, I understand this is for the long term, but $22,000 today, I'm not there. 15 sounds good to me. Right. Okay, and then you just work the number back. Well, to add 15,000 of taxes, you can convert this much, and really all those stars need to align to move forward with that strategy.
Absolutely. So Roth conversions are great, but don't do them blindly.
Yeah.
Do them in the context of a plan and really map it out and prepare for it.
That's a better way to say it.
No. So that's good for our person that is that's not quite of RMD age. If once you get to whether you do the conversions, but you still have large RMDs coming, we see that happen all the time. Or if for the person that maybe didn't hear about this till it was too late, there's a couple things people can do once they're in those RMD years where they can basically be smart with this. So one of them is a strategy that we love around here, and that's Qualified Charitable Distributions, or QCDs. QCDs are a great way to lower the RMD, because this is the process of taking money directly from the IRA and making the donation right to a charity or church of your choice. And as long as you do it this way and the money doesn't hit your bank account, then it won't hit your tax return.
Yeah, it's a beautiful thing. And I guess a fun fact for everyone out there, you're able to start doing QCDs at the age of 70 and a half. And
Before RMD age, right?
And so you're probably thinking to yourself, well, if we're trying to save or reduce our RMDs, why would I be doing this strategy before my RMD age? And so a couple of things. I mean, most people that take advantage of this strategy are charitably inclined. So if you're going to be giving to charity anyway and you're 70 and a half, you might as well not be taxed on those dollars. And then the other thing that comes along with that is that by you reducing the account value at 70 and a half going forward all the way to 73 or 75, that will reduce your future required distribution. So, I mean, indirectly, it does reduce the RMDs in the future. And I mean, this year, 2026, you're able to do a QCD of up to $111,000.
Isn't that awesome?
And so, I mean, and you may be thinking that's crazy. Why would I ever give that much? Well, the tax consequences on some of these required distributions that we're seeing or projecting out to be, I mean, even if you're not charitably inclined, it may make sense not to take the giant hit on you, because most people would rather see you go to a charity than go into the IRS.
Absolutely. It's so smart. And so I would put it this way. If there's anybody out there that's making donations now who's at least 70 and a half, it's a no-brainer. Switch the donation away and make it a QCD. 70 and a half and onwards, make those QCDs.
Absolutely. Yeah, it's a great strategy. Before we continue, if you want to explore working with a Seaside advisor, you can visit us at seasidewealth.com and schedule an intro call. And now back to the show.
So that's one thing. Now, for folks that just that would prefer not to, or maybe they say, maybe I give or maybe I don't give, but I certainly don't give 111,000. There's another thing people can do, and that's take the RMD, and even if they're forcing you to take out more than you want to, but then take the proceeds and invest them in a taxable account.
Yeah, so I like that idea. Here's a real life scenario of what most people are doing here is, say you're in your 70s and you haven't had a long-term care plan in place or something like that, and you don't or maybe you can't get long-term care insurance, or you don't want to use it or lose it kind of strategy, investing those dollars, saving up for future medical expenses. And if you're one of the lucky ones and don't have one of those episodes, then the dollars will be able to be passed on to your next generation as well.
Yeah. So a couple great things about this strategy, I'd say invest it in low-cost ETFs. So keep your investment costs low, try to grow the money to use for the future. But so for a married couple, at the first passing, that account's going to receive a step up in cost basis. So what I'm talking about here is along the way for your taxable account, you're responsible for paying taxes as you go. So capital gains, dividends, you're going to pay taxes on. By the way, if given a choice, we would favor qualified dividends in this type of account, because they're going to be qualified at the lower long-term capital gains rates of either 0, and we like tax-free, 15 or 20. So qualified dividends, not 100%, but the majority of the account, qualified dividends, and then low-cost ETFs. But at the first passing, when the first spouse passes, the surviving spouse receives a step up in cost basis to where then if they wanted, they could sell everything completely tax-free in that tax.
Yeah, and speaking of taxes, I mean, let's say the account continues to grow, but we all know market volatilities out there. When the market is down in your taxable account, you can take advantage of tax loss harvesting. We won't go into it on today's show, but we've got videos out there that you can go more details. But basically, it's selling one of your securities at a loss, replacing it with something very similar, and now you get to do two things with these losses. You can reduce your adjusted gross income each year by $3,000 a year, or you can use those losses to offset future gains. So it opens up another world of tax savings opportunities.
Yeah, and in that same vein, so if you are investing in a taxable account, the other way, instead of using ETFs, the other thing you could do is direct indexing, which is a strategy that, to your point, plays right into the tax loss harvesting. The only thing to consider is It does require a little bit extra capital to get started. You need about 250,000 for a direct indexing strategy. So if you had some cash lying around, you could couple that with your RMDs and then add all future RMDs to the direct indexing strategy. But it's a great way to invest. You still get the step up in basis, but now you get a much more robust tax loss harvesting approach.
Yeah, and the direct indexing opens it up where, 40% of securities are down in a year. So if you're using ETFs, within the ETF, same thing's happening. But if the ETF as a whole is up, you can't really target those down ones. So yeah, direct indexing, if you're looking for that strategy, happy to talk about that. It works really well.
Yeah, absolutely. And then the other question comes up for those folks that are in the RMD years. People ask us all the time, they go, can I just take my RMD and convert that? And so the answer is not really, but kind of. And so what I mean by that is the rules are very clear. If your RMD this year, let's say, is $50,000, you may not convert that $50,000. You must take the $50,000 and pay the full tax hit on that distribution. However, you can then convert anything beyond that $50,000 that you want to.
Right. Yeah. Another way to say that the RMD has to come out first, and then you can convert after that.
And so
good try though.
Yeah, right. I know. I wish. So, but I think it speaks to the importance, like you said earlier, tax planning is not a one and done thing. You need to be doing multi-year, multi-decade tax planning every single year, because oftentimes people might find themselves in the middle of a bracket. Many retirees out there are in that 22 to 24% bracket, but what they don't see is the older they get, those RMDs can force them up into the 32, the 35%, sometimes higher.
Right.
So it may make sense that if you find yourself, you're taking an RMD and you're in the middle of a 22% bracket, maybe you convert a few extra bucks all the way to the top of the 22, because in 10 years, you're actually going to be in the 32, and converting at 22 is a good deal.
And if you're thinking outside the box with that strategy, then it may make sense if you're in the 22 to just going into the 24, because that 2% jump isn't that big of a difference at that point. Knowing because of the tax planning that you're going to be in the 32, very, very good strategy that can save a substantial amount.
Yeah, and we talk about this all the time. All this is if tax rates don't go up in the future. You and I both think that taxes have nowhere to go but up because of the amount of debt that our country's servicing.
Well, you were saying it the other day. What are we at? So $1.10 of debt for every dollar that's coming in of revenue?
Yeah, something like that.
Well, so if it's close enough, that don't quote us on there, but the last time it was in this general ballpark was World War II.
Right.
And we saw where the tax rates were.
90% was the top marginal tax bracket coming out of World War II.
So just a reference point, 37% is the highest right now. He's saying that 90% was what it was then when we were in the similar debt to income ratio kind of thing.
So taxes have to go up in the future. So we may be looking back and going, gosh, I wish I converted at 22 or 24%, because now it's way higher.
Now the $22,000 check to the IRS doesn't sound so bad, because it could have been $44,000.
Well, no pain, no gain, I guess. Yeah. Well, I guess it's like going to the gym or working out with the trainer. It's doing the hard thing. These strategies are simple, but they're not easy to do. And truly, I think that's where the accountability comes in. Anybody can do these things. It's, maybe not the multi-decade tax projections, but the strategies we talked about today, anybody can do these things. What I find is most people don't do them.
Absolutely. That's what I find too. They're simple concepts in general terms speaking. We all know we need to be doing things like this or looking at things like this, but that implementation is really, really the difference from getting you, from 1 to 100.
Right.
Yeah.
So if you're out there and you're listening to some of these things and you're like, I just need help implementing, it's kind of like admitting I need a trainer at the gym or help with my nutrition or maybe a golf coach. If you need a financial coach, that's what we do.
Right.
Get in touch with us. We're happy to do these projections for you. We're happy to show you strategies to help lower that RMD in the future and really lower the lifetime tax bill, so you keep more of your hard-earned dollars in your pocket and give less to Uncle Sam. Because what we say is, don't tip the IRS.
That's right.
Yeah.
And that's the show. Thanks for listening. If you want to explore working with a Seaside advisor, you can visit us at seasidewealth.com. And if you're watching on YouTube, be sure to give us a like and subscribe. And if you want to find past episodes, that's at navigatingretirement.net.